Yield management formula. How to calculate yield at our hotel. There are numerous revenue management metrics that can help us evaluate how well our hotel is performing and allow us to change our strategy and boost revenue even if we do not increase sales. Nonetheless, this formula is one of the most commonly used in the hospitality business and is critical to calculate in order to have a baseline assessment of how well our hotel is doing. This is the simplest method for determining how much of our revenue potential we realized. Calculating the formula is as simple as revenue achieved divided by maximum potential revenue times 100%. Let's have a look at a practical example. A 150-room hotel with a rack rate of $200 has a total potential revenue of $30,000. On September 7th, they sold 60 rooms at $175. This generated $10,500 in room revenue. Plugged into the formula, it looks as follows. $13,300 divided by $25,000 times 100%. Therefore, the yield percentage is 35% for our example hotel on September 7th. However, without context, this is just a number. Analyze it in the context of a bigger picture to gain insights about our performance. For example, during periods of low demand, our yield will often be lower. To get a true picture, we compare our daily or weekly numbers to similar times. We also look at what's going on around us. For example, among competitors or in the market, to put our performance into context. Examine and act on these factors to improve our hotel's yield ratio. Booking window. We alter rates if we detect increased demand at the last minute. Positioning. In order to generate more bookings, we adjust our positioning relative to our competition. Macroeconomic factors. We assess overall business in our market, taking into account matters such as a recession, legislation, or a pandemic. Historical performance. We examine the same time last year to see whether we can anticipate similar results this year.